Hi everyone and welcome to Inderes TV. Today we're going to talk about Valmet with analyst Antti Viljakainen. Welcome.
Thank you.
The latest report, you called it neutral. Still there was a drop in revenue and also quite a dramatic drop in order intake. But how would you elaborate the neutral word?
If we start from the revenue side, it was expected that Valmet's revenue will decline in Q1 because the backlog was down at the end of last year, so no major surprises on the revenue side. Order intake fell below of my expectation and also consensus estimates. But if we look at the structure of the order intake, it was actually better than I estimated. Well profitable service order intake fell down from the comparison figures, but still landed at the second highest quartile ever, on well above our estimates. And the decline came mostly from equipment orders in process technologies, and these are significantly less profitable to Valmet than service orders and automation orders. Automation orders were quite in line with our expectations.
Okay, so now you actually touched upon what I was going to ask next about the different directions between the different segments here, and what is actually for the investors important to know here in the
well, the profitability difference is definitely a point that investors must take into
consideration.
account when looking at Valmet as investment. Also, these equipment orders can be extremely lumpy. Last year, Q1 was a very good quartile, so the percentage change looks even worse.
Yeah, more dramatic than it really is.
It actually is, even if the equipment orders were really on the low side. And then I would also like to highlight that service orders are driven by operating rates of customers in pulp and paper industry, and they are also much more stable than equipment orders that are driven by industry investments.
Okay, so this dramatic drop in order intake by 32%, that's actually explained by what you really said.
Yes, exactly. Exactly. It's not that bad figure.
It's not that dramatic as you would think.
How it looks like, but of course I'm not saying that it's good figure, but given this difference in profitabilities, I took that relatively neutral way, especially when we compare it to Valmet's valuation at the moment.
Yeah, so not good figures, but a good explanation behind them.
Yeah.
You said something about that the order intake nowadays, or in some cases, faster go to revenue than before. Did I ask this correctly? What did you mean, or what did you say?
That's correct.
The conversion to revenue on top line is faster than before.
Yes.
So could you elaborate on that? Because
this relates to the fact that a large equipment project may take 2 years or even more, and the order is recognized as revenue over the 2-year period. Then on the other hand, on the service side, if the customer orders, let's say, felt to the paper machine or some maintenance work, they book it they order today, and Valmet delivers the service or the product within quarter or two maybe.
Okay.
So it flows much faster to the revenue than large equipment order.
Yes, okay, then now I get it. And more about this in the report, of course. But what about valuation recommendation? You touched upon it, but please elaborate.
Yes, Valmet's valuation is very undemanding at the moment. PE multiples are slightly above 10 and EV/EBIT multiples below the same threshold. So I consider these very low levels for Valmet. The stock is yielding some 6% as dividend. So basically, I would say that at this point, nothing or very little value could be allocated to this lumpy equipment business, given the overall valuation of the stock. Current enterprise value of Valmet is justified just by service business and automation business that are having quite okay outlook from this point onwards.
So you basically get the other ones on top of it? Yeah.
For free. Yeah.
Okay. Thank you so much for these comments, and read more in the report below. Link down below.